When people talk about a currency crisis, they usually imagine something dramatic and far away. They picture wheelbarrows full of cash, stores changing prices by the hour, maybe some collapsing government in a country they've never been to. It feels like the kind of disaster that happened somewhere else, to someone else. But what if that picture is completely wrong? What if the real currency crisis doesn't begin when money becomes worthless overnight? What if it begins much earlier, much quieter, when your money still looks stable, your paycheck still arrives on time, and your bank account still shows the numbers you expect to see? What if the crisis starts the moment a society realizes that its currency is no longer preserving a middle-class life, even though on paper everything still looks normal? And that is the paradox. Because the middle class does not disappear all at once, it gets erased in slow motion, not by a single crash, but by a system that keeps telling people they're safe while steadily stripping away what their money can actually do. A currency doesn't have to collapse to destroy the middle class. It just has to lose its ability to store a decent life. So let's talk about what money is actually supposed to do. At the most basic level, a currency has three jobs. It has to work as a medium of exchange, a unit of account, and a store of value. Most people focus on the first two. Can you spend it? Yes. Are prices listed in it? Yes. Then everything must be fine. But the third job, the store of value, that's the one that matters most to ordinary people trying to build a life. Because the middle class doesn't live off transactions, it lives off delayed reward. You work now, save now, plan now, and trust that those sacrifices will still mean something 5 years from now, 10 years from now, 20 years from now. That trust is the foundation of everything. It's what makes people save for a home. It's what makes them believe they can pay for education. It's what makes retirement seem possible. It's what allows a teacher, an engineer, a small business owner, a nurse to believe that discipline and patience still lead somewhere. But here's where things start to break. When governments and central banks face real pressure, they almost never choose immediate pain. They choose delayed pain. They choose the kind of pain that is harder to trace, harder to blame, and easier to politically survive. And the cleanest way to do that is through the currency itself, not by destroying it in one spectacular moment, but by quietly diluting it. Now, at first glance, inflation looks like the obvious villain here. And yes, inflation matters. Everybody feels it. Rent goes up, food gets more expensive, insurance jumps, childcare climbs. Suddenly, the same salary that felt decent a few years ago starts feeling strangely inadequate. But the problem isn't just inflation. The problem is the gap between what the currency is losing and what middle-class incomes are gaining. That gap is where the real crisis lives. If prices rise 20%, but wages rise 8%, the currency may still look stable on a chart. The system may still be called healthy. Politicians may still talk about resilience, but the middle class is already moving backward. Think about what that actually means in real life. It means the family that could once save now carries revolving debt. It means the down payment keeps moving further away, even as they work harder. It means a house stops being a home and becomes a financial fortress they can no longer enter. It means two incomes become mandatory where one used to be enough. It means retirement becomes a fantasy. It means doing everything right no longer works. And once that happens, something deeper begins to crack. Because the middle class is not just an income bracket, it's a psychological contract. It's the belief that effort, restraint, and long-term planning will be rewarded. When a currency stops protecting that contract, trust starts to die, slowly at first, then all at once. So how does a society get to that point? Usually it begins with debt, a lot of debt. Modern states are built on promises. Pensions, health care, defense, subsidies, social programs, interest payments, emergency bailouts. In good times, those promises expand. In bad times, they almost never shrink. And that means when growth slows and obligations rise, governments run into the same problem over and over again. They owe more than the political system can honestly pay for. So they borrow. And then they borrow more. And for a while, that looks manageable. As long as interest rates stay low and markets stay calm, the illusion holds. Debt rolls over. Deficits continue. Asset prices rise. Consumers keep spending. Politicians declare success. But here's the twist. That entire model depends on one thing above all else: confidence in the currency. Because once a government becomes deeply dependent on debt, it becomes deeply dependent on keeping the financial system liquid, stable, and functioning. And when that system starts to wobble, central banks step in. They cut rates, they inject liquidity, they buy assets, they expand balance sheets. They do whatever they have to do to stop the machine from seizing up. And every time they do, they send the same message to the market. We will not allow real deflationary pain, even if it means weakening the currency underneath everything else.
This is why the middle class gets trapped. The wealthy often own the assets being protected: stocks, real estate, private equity, businesses, hard assets. When the system gets flooded with money, those things tend to recover first and rise fastest. The poor, at least in theory, may receive targeted support, subsidies or transfer payments, though often not enough. But the middle class sits in the most dangerous position of all. It holds cash savings. It depends on wages. It buys homes at inflated prices. It pays taxes in full view of the state. It has too much to qualify for relief and too little to shield itself with real assets. It is exposed to the currency from every angle. And this leads to one of the ugliest truths in the modern economy. Inflation is not just an economic event. It is a distribution mechanism. It decides who absorbs the cost of systemic failure. When money is cheap, debtors are rescued. Governments get breathing room. Corporations refinance. Asset holders see prices rebound. But wage earners and savers, especially those trying to climb into stability, absorb the hidden loss. Their money buys less. Their labor stretches less far. Their caution is punished. That's why a currency crisis can erase the middle class without ever producing the kind of chaos people expect. No mobs, no banknotes blowing down the street, no formal announcement that the system has failed. Just a population that gradually realizes life is becoming mathematically impossible. And once people feel that, their behavior changes. They stop saving in cash because cash feels stupid. They speculate because investing becomes survival. They chase housing, not because they need a home, but because they're terrified of being locked out forever. They take on leverage because caution no longer keeps up. They stop trusting official inflation numbers because their own lives feel more expensive than the data says they should. And that loss of trust is where the crisis becomes self-reinforcing. Because a stable currency is ultimately a social agreement. It only works if people believe that holding it is rational. The moment enough people conclude that the best strategy is to get out of cash and into anything else, the currency starts to lose its social legitimacy, even if it keeps its legal status. Now that would already be dangerous enough, but it goes deeper than that. Because the middle class is the tax base, it is the mortgage base, it is the consumption base, it is the political stabilizer. It is the group that turns wages into schools, neighborhoods, businesses, retirement systems, and generational mobility. If that group starts shrinking, the damage doesn't stay confined to household budgets, it spreads through the entire structure. Fewer families can buy homes with extreme debt. Fewer workers can afford children. Fewer local businesses survive on discretionary spending. More people need state support. More resentment builds between owners and non-owners, older generations and younger ones, asset-rich cities and wage-dependent regions. And that's when the currency crisis stops being about prices and starts becoming about legitimacy. Because citizens begin asking a brutally simple question. If the money is still working, why is life no longer working? Why does a full-time salary no longer buy what it used to buy? Why does economic growth feel rich on paper and poor in reality? Why are markets booming while households feel cornered? Why does every solution seem to make assets more expensive and labor less meaningful? The official answer is usually some version of adaptation, upskill, move, invest earlier, take more risk, compete harder. But there's a limit to how much adaptation a middle class can do when the underlying unit of reward keeps weakening. You can't build long-term stability on a currency that encourages short-term panic. And this is where history starts whispering something uncomfortable. Governments almost always frame currency debasement as necessity. They say it's temporary. They say it's to support employment, preserve stability, avoid recession, defend the system. And to be fair, sometimes the alternatives really are ugly. But every intervention creates a precedent. Every rescue teaches markets what will be protected. Every round of easing tells debtors to continue. Every inflation spike that goes undercorrected tells savers they are not the priority. And eventually, a society wakes up to a very strange reality. The currency still circulates, the system still functions, elections still happen, banks still open, but the path into a middle-class life has narrowed so much that it begins to feel reserved for those who already got there first. That's when a society becomes brittle. Young people delay adulthood because it costs too much to begin. Families stop forming because the numbers don't work. Professionals burn out because income gains vanish into essentials. Retirees watch purchasing power decay. Workers become more radical, more cynical, more willing to abandon institutions that no longer feel reciprocal. And then the political system enters the trap. Because once the middle class is under sustained pressure, every solution becomes dangerous. Raise interest rates aggressively, and you crash debt-heavy households, over-leveraged firms, housing markets, and government finances. Keep rates too low, and you continue eroding the currency and inflating asset inequality. Cut spending, and voters revolt. Increase spending, and deficits widen. Tighten money, and unemployment rises. Loosen money, and purchasing power falls. This is the real nightmare. Not that policymakers don't know there's a problem. It's that by the time the middle class feels the full weight of the crisis, nearly every exit hurts. And that leaves one final paradox. The institutions managing the currency are usually trying to preserve social order. But the very tools they use to preserve the system in the short term may be the very same tools that hollow out the middle class in the long term. Stability becomes the mechanism of erosion. Rescue becomes the source of fragility. The thing designed to protect confidence slowly destroys it. So, when people ask what a currency crisis looks like, maybe they're asking the wrong question. Maybe the real sign is not a collapsing banknote, but a collapsing life trajectory. A generation that can earn, but not accumulate. A household that can pay bills, but not get ahead. A saver who becomes a speculator just to stand still. A society where money still moves, but mobility dies. And if that process keeps going, if the currency keeps doing a worse and worse job of storing the value of ordinary effort, then the middle class doesn't need to be abolished by law. It just gets priced out of existence. Which leaves us with the question nobody in power ever wants to answer honestly.
If preserving the financial system requires sacrificing the purchasing power, stability, and future of the middle class, then what exactly is the currency still protecting?